Reading 32, Financial Statement Analysis Applications. Reading 32, Financial Statement Analysis and Applications. Learning outcome, evaluate a company's past financial performance and explain how a company's strategy is reflected in past financial performance. Forecast a company's future net income and cash flow. Describe the role of financial statement analysis in assessing the credit quality of a potential debt investment. Describe the use of financial statement analysis and screening for potential equity investments. Explain appropriate analysts' judgment to company's financial statements to facilitate comparisons with another company. Introduction. This reading presents several important applications of financial statement analysis. Among the issue, we will address the following. What are the key questions to address in evaluating a company's past financial performance? How can an analyst approach forecasting a company's future net income and cash flow? How can financial statement analysis be used to evaluate the credit quality of a potential fixed income investment? How can financial statement analysis be used to screen for potential equity investments? How can differences in accounting methods affect financial ratio comparisons between companies, and what are some adjustments analysts make to reported financial shows to facilitate comparability among companies? The reading, Financial Statement Analysis, an introduction, describes a framework for conducting financial statement analysis consisting with the framework. Prior to undertaking any analysis, an analyst should explore the purpose of the context of the analysis. The purpose and context guide further decisions about the approach and tools, the data sources, and the format in which the report results of the analysis, and also suggest which aspects of the analysis are most important. Having identified the purpose and context, the analyst should then be able to formulate the key questions, and the analyst must address the questions. Will suggest the date an analyst needs to collect objectively addresses the questions. The analyst can then process and analyze analysis and communicate the format appropriate to the context, and follow-up is undertaken as required. Although this reading will not formally present applications as a series of steps, the process just described is generally applicable. Section 2 of this reading describes the use of a financial statement analysis to evaluate a company's past financial performance. Section 3 describes basic approaches to projecting a company's future financial performance. Section 4 presents the use of financial statements. Financial statement analysis and assessing of the credit risk, the credit quality of a potential debt investment. Section 5 concludes the survey of applications by describing the use of financial statement analysis in screening for potential equity investments. Analysts often encounter situations in which they must make adjustments to a company's reported financial results to increase their accuracy or comparability with the financials of other companies. Section 6 illustrates several common types of analysts' adjustments. Section 7 presents a summary and practice problems in CFA Institute multiple choice format and concludes the reading. Application, evaluation of past financial performance. Analysts examine a company's past financial performance for a number of reasons. Cross-sectional analysis of financial performance facilitates understanding of the comparability of companies for market-based valuations. Analysis of a company's historical performance over time can provide a basis for forward-looking analysis of the company. Both cross-sectional and trend analysis can provide information for evaluating the quality and performance of a company's management. And evaluation of a company's past performance addresses not only what happens, i.e., how the company performed, but also why it happened, the cause behind the performance, and how the performance reflects the company's strategy. Evaluative judgment assesses whether the performance is better or worse than the relative benchmark, such as the company's own historical performance, a competitive performance, or a market's expectations. Some key analytical questions include the following. How and why have corporate measures of profitability, efficiency, liquidity, and solvency changed over the periods being analyzed? How do the levels and trends in a company's profitability, efficiency, liquidity, and solvency compare with the corresponding results of other companies in the slum industry? What factors explain any differences? What aspects of performance are critical for a company to successfully compete in the industry, and how did the company perform relative to those critical performance aspects? What are the company's business models and strategies, and how do they influence the company's performance as reflected in, for example, its sales growth, efficiency, and profitability? Data available to answer these questions include the company's financial statement, material from company's investors relation department, corporate press releases, and non-financial statement regulatory filing, such as proxies. Useful data include industry information, consumer information, and information that is gathered by analysts firsthand. Processing the data typically involves creating common-sized financial statement, calculating financial ratios, and reviewing or calculating industry-specific metrics. Example 1 illustrates the effects of strategy on performance and the use of basic economic reasoning in interpreting results. To illustrate the use of the war chest, example 2 provides descriptions of several companies' cash positions and potential uses of their funds. When a company has accumulated large amounts of cash, an analyst should consider the likely implications of a company's strategic actions or financing decisions. In calculating and interpreting financial statements ratios, an analyst needs to be aware of the potential impact of the financial statements and related ratios of companies reporting under different accounting standards, such as International Financial Reporting Standards, IFRS, and U.S. Generally Accepted Accounting Principles, U.S. GAAP, or other home countries, GAAP. Furthermore, even within a given set of accounting standards, companies have great discretion to choose among accountable methods. A company also may make different assumptions and estimates even when applying the same method to another company. Therefore, making selected adjustments to a company's financial statements data may be useful to facilitate comparisons with other companies or with the industry overall. Examples of such analyst adjustments will be discussed in Section 6. Non-U.S. companies that use any accountable body of accounting standards and file with U.S. SEC are required to reconcile their net income and shareholders' equity accounts to U.S. GAAP. Note that in 2007, the SEC eliminated the reconciliation requirements for non-U.S. companies using IFRS, and filing with SEC. Example 2 uses recognition data from SEC filing to illustrate how differences in accounting standards can affect financial ratios comparison. The difference in the example are very large. In example 2, 2009 ROE for both TMX and TNE differed substantially under home country GAAP and US GAAP. In general, because the reconciliation data are no longer required by the SEC, we cannot determine whether differences in net income, equity, and thus ROE also exist between IFRS and the company's home country GAAP. Also including U.S. GAAP. Historically, research indicates that for most non-U.S. companies filing with SEC, differences in net income between U.S. GAAP and home country averages between 1 to 2% per market value of equity, but large variations do occur. Additionally, research indicates that for most non-U.S. companies filing with SEC ROC, historically under IFRS and under U.S. GAAP, comparisons of the levels of trends in a company's performance provides information about how the company performed. The company's management presents its views about causes underlying its performance and its measurement commentary or management discussion and analysis section of its annual report and during periodic conference calls with analysts and investors to gain additional understanding of the causes underlying a company's performance. An analyst can review industry information or seek information from additional sources such as consumer surveys. Let me drink my juice. I'm drinking cranberry juice today. The results of an analysis of past performance provides a basis for reaching conclusions and making recommendations. For example, an analysis undertaken as the basis for a forward-looking study might conclude that the company's future performance is is not likely to reflect continuous of recent historical trends. Another example, an analyst to support a market-based valuation of a company might focus on whether the company's profitability and growth outlook, which is better or worse than the peer group medium, justifies the relatively high or low valuation. The analyst would consider market multiples such as price to earnings ratios, price to book ratios, and total invested capital to be EBITDA. And as another example, an analyst undertaken as part of evaluation of management of two companies might result in conclusions about whether one company has grown as fast as another company or as fast as an industry overall, and whether each company has maintained profitability while growing. Applications, projecting into future financial performance. Projections of future financial performance are used in determining the value of a company or its equal component. Projections of future financial performance are also used in credit analysis, particularly in project finance and or acquisition finance, to determine whether a company's cash flow will be adequate to pay the interest and principal on its debt, and to evaluate whether a company will likely remain in compliance with financial covenants. Sources of data for analysis projections include some of all of the following: the company's projections, the company's previous financial statements, industry structure and outlook, and macroeconomic forecasts. Evaluating a company's past performance may provide a basis for forward-looking analysis. An evaluation of a company's business and economic environment and its history may persuade the analyst that historical information constitutes a valid basis for such analysis, and that the analyst's projections may be based on the continuous of past trends, perhaps with some adjustments. Alternatively, in the case of major acquisitions or divestitures, the startup company for a company operating in a volatile industry, past performance may be less relevant to future performance. Projections of a company's near-term performance may be used as an input to market-based valuations or relation valuation. These calculations will lead to the development of an income measure for valuation calculations, such as net income, earnings per share, EPS, or EBITDA. More complex projections of a company's future performance for multiple periods, for example, projections of sales and gross margins by product line, projections of operating expense based on historical patterns, and projections of interest expense based on requisites, debt fundings, interest rates, and applicable taxes. Furthermore, a projection should include sensitivity analysis applied to the major assumptions. Projecting performance and input to market-based valuation. When application to financial statement analysis involves projecting a company's near-term performance as an input to market-based valuations, for example, an analyst might project a company's sales and profit margins to estimate EPS and then apply a projected EPS to establish a target price for a company's stock. Analysts often take a top-down approach to projecting a company's sale. First, industry sales are projected on the basis of their historical relationship with some macroeconomic indicators, such as growth in real gross domestic product (GDP). In researching the automobile industry, for example, the analyst may find that industry annual domestic unit car sales bears a relationship to annual changes in real GDP. Regression analysis is often used to establish the parameters of such relationships. Other factors in projecting sales may include consumer income or tastes, technological development, and the availability of substitute products or services. After industry sales are projected, a company's market share is projected. Company-level market share projections may be based on historical market shares and a forward-looking assessment of the company's competitive positions. The company's sales are then estimated at its projected market share multiplied by projected total industry sales. After developing a sales forecast for a company, an analyst could choose among various methods for forecasting income and cash flows. An analyst must decide on the level of detail to consider in developing forecasts. For example, separate forecasts may be made by individual expense items or more aggregated expense items, such as total operating expenses. Rather than stating a forecast in terms of expenses, the forecast might be stated in terms of a forecasted profit margin. The net profit margin, in contrast to the gross or operating profit margins, is affected by financial leverage and tax rates, which are subject to marginal and legal regulatory revisions. Therefore, historical data may sometimes be more relevant for projecting gross or operating profit margins for the projections for the projecting net profit margins. Whatever the margins are used, the forecasted amount of profit for a given period is the product of the forecasted amount of sales and the forecast of the selected profit margin. As example 3 illustrates, for relatively mature companies operating in non-volatile product markets, historical information on operating profit margins can provide a useful starting point for forecasting future operating profits. Historical operating profit margins are typically less reliable for projecting future margins for a new or relatively volatile business, or one with significant fixed costs, which may magnify the volatility of operating margins. Although prior year's profit margins can provide a useful starting point to projections for companies with relatively stable businesses, the underlying data should nonetheless be examined to identify items that are not likely to occur again in the following years, such as non-recurring or transitionary items should be removed from computation of any profit amounts or profit margins that will be used in projections. Example 4 illustrates this principle. In general, when earnings projections are used as foundations for market-based valuations, the analyst will make appropriate allowance for transitionary components of past earnings, projected multiple period performance. Projections of future financial performance over multiple periods are needed in valuation models to estimate the value of a company or its equal to discounting future cash flows. The value of a company or its equal development in a way can be compared to its current market price as a basis for investment decisions. Projections of future performance are also used for credit analysis. These projections are important in assessing a borrower's ability to repay interest and principals of debt obligations. Investment recommendation depends on the need to the objectives of the client and on the evaluation of the risks of the investment relative to its expected return, both of which are functions of the term of the debt obligation itself as well as the financial market conditions. Terms of the obligation include amount, interest rate, maturity, financial covenants, and collateral. Example 5 presents an elementary illustration of net income and cash forecasting to illustrate a format for analysis and some basic principles. Example 5 assumptions are shown first. Then the period-by-period abbreviated financial statement resulting from the assumptions are shown. Depending on the use of the forecast, an analyst may choose to compute further, more specific cash flow metrics. For example, free cash flow to equity, which is used to discount cash flow approaches to equity valuations, can be estimated as net income adjusted for the non-cash items minus investments in net working capital and net fixed assets plus net borrowing. Example 5 is simplified to demonstrate some principles of forecasting and practice. Each aspect of a forecast presents a range of challenges. Sales forecasts may be very detailed with separate forecasts for each year of each product line, each geographical and or business segment. Sales forecasts may be based on past results. Management forecast, industry studies, and or macroeconomic forecasts. Similarly, gross profit margins may be based on past results or forecast relationships and may be detailed. Expenses, on the other hand, on costs sold, may be broken down into more detailed lined items, each of which may be forecasted on the basis of relationship with sales if available, or on the basis of historical levels. Working capital requirements may be estimated as a proportion of the amount of sales. or the changes in the sales or the compilations of specific forecasts for inventory, receivables, and payables. Most forecasts will involve some investment in fixed assets, in which case depreciation amounts affect taxable income and net income, but not cash flow. Example 5 makes the simplifying assumptions that interest is paid on the beginning of the year cash balance. Example 5 hold on, let me drink my juice real fast. Example 5 develops a series of point estimates for future net income and cash flow. In practice, forecasting generally includes an analysis of risks and forecasts. In this case, an assessment of the impact on income and cash flows. If the realized value of variables differs significantly from the assumptions used in the base case, or if actual sales are much different from forecasts, qualifying the risks and forecast requires an analysis of the economics of the company's business and expense structure, and the potential impact of events affecting the company, the industry, and economy in general. When that investigation is completed, the analyst can use a scenario analysis or Monte Carlo simulation to assess risk. Scenario analysis involves specifying assumptions that differs from those used as a base case assumption. Example 5, the projections of net income and cash flow could be recast in the most pessimistic scenario, with assumptions changed to reflect slower sales growth or higher costs. A Monte Carlo simulation involves specifying probability distributions of values for variables and random sampling for those distributions. In the analysis of example 5, the projections were to be repeatedly recast with the selected value of the drivers of net income and cash flow, thus permitting the analyst to evaluate a range of possible results. That the profitability of simulating the possible actual outcomes. An understanding of financial statements and ratios can enable an analyst to make more detailed projections of income statements, balance sheets, and cash flow statement items. For example, an analyst may collect information on normal inventory and receivable turnovers and use the information to forecast account receivables, inventory, and cash flow based on sales projections rather than the use of composite working capital investment assumptions in example 5. An analyst makes detailed forecasts. He or she must ensure that the forecasts are consistent with each other. For instance, in example 6, an analyst forecast concerning days of selling outstanding should flow from a model of a company that yields a forecast of the change in the average cost receivable balance. Otherwise, the predicted days of sales outstanding and accounting receivables will not be mutually consistent. Application: assessing credit risk. Credit risk is the risk of loss caused by counterparties or debtors' failure to make a promised payments. For example, a credit risk with respect to a bond is when the risk that the obligator will not be able to pay interest and or principal according to the terms of the bond indenture or the contract. Credit analysts in the evaluation of credit risk, credit analysis may relate to credit risk of an obligor in a particular transaction or in an obligor's overall creditworthiness. In assessing an obligor's overall creditworthiness, the general approach is credit scoring, a statistical analysis of the determinants of credit defaults, credit analysis for specific types of data. Whatever the techniques adopted, the analytical focus of credit analysis is on debt paying ability. Unlike payments to equity investors, payments to debt investors are limited by the agreed contractual interest. If a company experiences financial success, its debt becomes less risky, but its success does not increase the amount of the payments to its debt holders. In contrast, the company experienced financial distress, it may be unable to pay interest and principal on the debt obligation. Thus, credit analysis has a special concern with the sensitivity of debt paying ability, the adverse event of economic conditions, case in which the creditor's promised returns usually focuses on cash flows rather than the actual income. Typically, credit analysts use return measures related to operating cash flow because it represents cash generated internally, which is available to pay creditors. These themes are reflected in example 7 with illustration and applications to an industry group of 4 groups of qualitative factors in credit analysis: skills of diversification, tolerance of leverage, operational efficiency, and margin and stability. Skills and diversification relates to the company's sensitivity to events, adverse economic conditions, and other factors such as market leadership, purchasing power with suppliers, and access to capital markets, and may affect the debt paying ability. Other factors include interest coverage ratios based on EBITDA, which are also chosen by Moody's in specifying factors for operating efficiency and margin stability. Operational efficiency is defined as Moody's relates to the cost structure. Companies with lower costs are better positioned to deal with financial stress. Marginal stability or margin stability relates to the past volatility of profit margins. Higher stability should be assessed by the lower credit risk. Moody's evaluation of qualifiable ratings from a specific industry. A point to note regarding example 7 is that the rating factors and the metrics are to represent each can vary by industry group. For example, for heavy manufacturing, Moody's distinguishes order trends and quality as distinctive credit factors affecting future revenues, factory load and profitability patterns. Analysis of a company's historical and projected financial statements and an integral part of a credit evaluation process. As noted by Moody's, financial statement information is an important source of information for a rating process. Much of the information used to assessing performance for the sort of sub-factor is found or calculated using the company's financial statements. Others are derived from observations or estimates by the analyst. Moody's rating are followed looking and incorporate our expectations for future financial and operating performance. We use both historical and projected financial results as our rating process. Historical results help us understand patterns and trends for a company's performance as well as their previous comparisons. As noticed, Moody's computes a variety of ratios in assessing creditworthiness. A comparison is a company's ratio with a ratio of the peers and informative in evaluating relative creditworthiness and demonstrated in example 8. Before calculating ratios such as those presented in example 8, rating agencies must make certain adjustments to reported financial statements, which are adjusting debt to include off-balance sheet balance in a company's total debt. When we describe this section 6 share common adjustments, financial statement analysis, especially financial ratio analysis, can also be an important use in selecting quality investments, as discussed in the next section. Application screening and potential equity investments. Ratio constructions for financial statement data and market data are often used to screen for potential equity investments. Screenings in the applications of the set of criteria to reduce a set of potential investments to a smaller set having certain desired characteristics. Criteria involving financial ratios generally involve comparing one or more ratios with some pre-specified target or cutoff value. A security selection approach incorporates financial ratios may be applied whether the investor use top-down analysis or bottom-up analysis. Top-down analysis involves identifying attractive geographical segments and or industry segments from which the investor chooses the most attractive investment. Bottom-up analysis involves the selection of investments from all companies within specified industry investment universe, regardless of the direction. Screening for potential equity investment aims to identify companies that fundamental to the type of analysis are decisions about what metrics is used as screens. How many metrics are included, to what value are those metrics to use the cutoff points, and what weighting to give each metric. Metrics may include not only financial ratios but also characteristics such as market capitalization or membership as a component security in a specified index. Example 5 presents a hypothetical example of a simple stock screen based on the following criteria: valuation ratio PE less than the specified value, a solvency ratio measuring financial leverage, greater than the specified value. Exhibit 5 shows the results of applying the screen in August 2010 to set 5,187 US compares with market capitalization greater than 100 million, which composes of a historical equity manager's investment universe. Analysis adjustments to reporting financials. When comparing companies that use different accounting methods to estimate key accounting inputs in different ways, analysts frequently adjust a company's financials. In this section, we first provide a framework for considering a potential analysis adjustments to facilitate such comparisons, and then provide examples of such adjustments in practice. The required adjustments vary widely. The example presented here are not intended to be comprehensive, but rather illustrate the use of adjustments to facilitate a meaningful comparison. A framework for analysis adjustments. In this discussion, the potential analyst adjustments to the company's financial statement. We use a framework focused on the balance sheet because the financial statement and are interrelated. However, adjustments to items reported on one statement may also be reflected in adjustments to items on another financial statement. For example, an analyst adjustment inventory on balance sheet. Yeah. Okay. Regardless of the particular order in which an analyst considers the item that may be required adjustments for comparability, the following aspects are appropriate. Importance, body of standard, method, estimation. Analyst adjustments are related to investment, accounting for investment in the debt and equity securities of a company's depend on the manager's intentions. Trade and security may make them available for sale, or in the case of debt securities, held to maturity. When securities are classified as financial assets measured at fair value through profit or loss, similar to trading securities in US GAAP, unrealized gains and losses are reported and the same on the income statement. When securities are classified as financial assets measured at fair value through other comprehensive income, unrealized gains and losses are not reported in the income statement and instead are recognized in equity. If two otherwise comparable companies have significant differences in the classification of investments, analyst adjustments may be useful to facilitate comparisons. Analyst adjustment related to inventory. With inventory adjustments may be required to differ accounting methods, as described in previous readings. A company's decision about inventory method will affect the value of inventory stock shown on the balance sheet, as well as a value of inventory that is sold. cost of goods sold. If a company not reporting under IFRS uses LIFO, or last in first out, and other uses FIFO, or first in first out, comparability of the financial results and of the two companies will suffer. Companies that use the LIFO method must have, however, disclosed the value of the inventory under the FIFO method. The recent inventory results for a company companies LIFO reporting on FIFO basis. The analysis adds the ending balance of the LIFO reserve to the ending value of inventory under LIFO accounting to adjust cost of sales to a FIFO basis and under LIFO accounting. In summary, the information disclosed by companies that use the LIFO allows the analyst to calculate the values of the company's inventory as if the company were telling the FIFO method. In estimation, in example 10, the portion of inventory valued under the LIFO method was a relatively small portion of total industry. The LIFO reserve will also relatively small if the LIFO method is used for a substantial part of a company's inventory and the LIFO reserve is large relative to reported inventory. However, the adjustments to the FIFO basis can be important for comparisons of the LIFO expecting companies with a company that uses the LIFO method to inventory valuation. Example 11 illustrates a case in which such adjustments will have a major impact on the analyst's conditions. Analysts adjusting relative to off-balance sheet financing. A number of business activities give rise to obligations that, although there are economically liabilities of the company and not required by the reported of the company's balance sheet, indicating such rip-offs balance sheets real rev in RT. The right of a lease may be similar to the right of the owner, but if the terms of the lease are structured so that it can be accounted for only an operating lease, the lease is treated as a central contrast, and either the leased or either the associated liability is reported on the balance sheet. When what is certain to analysts is when a lease conveys to the leasee most of the benefits and risks of ownership, but the lease is accounted for. An operating lease give rise to off-balance sheet functioning information accounting standard setters and rise of the balance sheet in financing. International accounting standard setters have stated that the entity should not be avoided because the sheet recording of leases through artificial leasing structures. A 2005 report by the U.S. SEC on off-balance sheet financial estimates estimates that more than 63% of companies in the U.S. having a reporting operating lease. The SEC estimates of total future lease payments under operating lease of $1.2 trillion over the remaining terms of the lease. Because companies are required to disclose in their financial statement the amount and timing of lease payments, and analysts can use the information to answer the charity. How would a complex financial position look on operating clause or obligations when included into the total liabilities? Exhibit A presents such a concept. Summary: This reading describes applications of financial statement analysis, including the evaluation of past financial performance, the projections of future financial performance, and the assessment of credit risk, and the screening of potential equity investments. In addition, the reader introduced analyst adjustments to reported financials. In all cases, the analyst needs to have a good understanding of the financial reporting standards under which the financial statements were prepared. Because standards evolve over time, analysts must stay current in order to make good investment decisions. The main points of the reading are as follows. Evaluating a company's historical performance suggests not only what happened, but also what caused behind the company's performance and how the performance reflects the company's strategy. The projections of a company's future net income and cash flows often begins with a top-down sales forecast, in which the analyst forecasts industry sales and the company's market sales by projecting profit margins or expenses and the level of investment in working and fixed capital needed to support projected sales. The analyst can forecast net income and cash flows. Projections of future performance are needed for discounted cash flow valuations of equity and are often needed for in credit analysis to assess a borrower's ability to repay interest and principal of a debt obligation. Credit analysis uses financial statement analysis to evaluate credit relevant factors, including a tolerance to leverage, operating stability, and marginal stability. When ratios constructed from financial statement data and market data are used to screen for future potential investments, fundamental decisions include which metrics is to use as screens, how many metrics are included, what values of these metrics to use as cutoff points, and what weighting to give each metric. An analyst adjustments to a company's reported financial statement are sometimes necessary. E.g., when comparing comparing companies to the different accounting methods or assumptions. Adjustments include the relating investment, inventory, property, plant and equipment, goodwill, and off-balance sheet financing. So this is reading 32. We have finished financial reporting and analysis, which is the accounting section for CFA level 1. And here's the glossary, as all of the I think the text doesn't start until 21:30. So corporate finance is next. Corporate finance is a heavy chapter. So here's chapter 32. Hope my readings have been helpful, and I hope to see you guys next time. Goodbye.